Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value, and I'm always looking for potential investment opportunities. But in this video, I want to talk about, there's a couple of questions in the comment section. I want to really talk about technical analysis versus fundamental analysis and the difference between the two. The question here is, do you actually check company fundamentals, PE ratios, earnings growth, etc., or literally just look at technical analysis? So here's the problem when you invest in commodities. The first thing I look at is the real estate market. The real estate market determines if it's an inflationary environment or a deflationary environment. That's what I've linked. You can literally go back in history, look at housing starts, and link it to M2 money supply. I know that they're printing like heck recently, but that was the mechanism for inflation. The driver of inflation is the real estate market and that cycle. That influences interest rates, which rotates money between asset classes. Now, if you're in commodities and you're looking at commodities and you want to buy the bottom of commodities, where you just want to kill it in life, you want to retire young, you want to take vacations, or you just want to do whatever you think is awesome. You can't go off the company's fundamentals because what happens is you're gonna get a. So I'll revert back. We do ratio analysis on the channel. We price asset against asset, and when you price those two assets against each other, commodities have never been this cheap in over 100 years. Against stocks, stocks are completely overvalued. They're going to get decimated at some point. I'm really not interested in stocks at this time. They are vastly overvalued on PE ratio, on the fundamentals, PE ratios, all that stuff, the CAPE ratio. It's all garbage. It doesn't even matter what their earnings are because their PEs are so big. When interest rates go up, it's going to be a hurricane force wind against them. You've heard me say that before. Now, at a bottom, if I were to completely take the charts away and I were to completely take the ratio analysis away, where you don't know what sector's cheap and what sector's expensive, and all you focused on was the fundamentals, the PE ratios, the earnings growth, all of those things. If that's all you focused on, you know what you'd end up doing? You would end up losing a ton of money in commodities. And you'd be buying the tops and selling the bottoms, or selling as you're coming back down. Because the fundamentals look the worst at the bottom and look the best at the tops. So really what drives commodities is the price of the commodity. The company is laid, we'll call it, is laid victim to the commodity price. They can't do anything. They don't control the commodity price. They are the slave of the commodity price. The master is the commodities in the market. The slaves are the companies of those commodities, whatever they produce. So when you have these gigantic, big bull markets in commodities, they happen under inflationary periods. It's when the dollar falls out and money seeks commodities and hard assets. So when you tie that all together, when you tie real estate, when you tie inflation to real estate, when you tie interest rates to inflation, and then when you tie the rotation of money into hard assets based off of interest rates, you've got the entire picture. Now, on this channel, we look at the big trend. What I am proposing, because we're going into an expansion phase of real estate, and a lot of people already know this, is you're gonna get that rotation of money into hard assets. We've got the ratio that's never been this cheap, which means in my opinion, we have the largest opportunity ever in commodities that has ever existed in our lives or probably in anyone's lifetime. They've never been so oversold and stocks have never been so overbought. If and when interest rates go up and that rotation of money happens, that money is going to rotate into our stuff. It's the best setup I've ever seen in my life. And if you've bought the bottom of this, or if you get anywhere near the bottom, like a lot of the companies that we're looking at, a lot of the stuff I'm charting on these big patterns, technical analysis gives you that edge. you're going to have to walk away in a commodity company away from the fundamental PE ratios, because when the commodity price goes up, those fundamentals change so fast that you can't really use them. So what I end up looking at is what's insider ownership. What's the share dilution? How much debt do they have? Can they survive the bottom? If they can survive the bottom and they've got this massive technical pattern where it went from like $5 to $150 last bull market, and now we're back at $5, that's a very good value proposition. And you know what? A lot of people aren't going to invest in it because they're looking at the fundamentals. So what you have to look at you're going to have to look at this a little bit different than you would a company that controls its selling price, like a Chipotle or an Apple. You can't value these things the same. So what you really want to do, the best opportunities that I've ever seen are companies that have debt. They have a lot of debt, and they have a bunch of assets that can produce whatever the mineral is, or oil or natural gas. Usually oil and natural gas are the ones that take on a lot of debt. Now, if we go into an inflationary period, oil, natural gas, and uranium are the three that are the most inflation. They adjust the largest under inflation. They're the biggest inflation hedges in the commodity sector. Therefore, they are some of the best investment opportunities ever. And the reason I say the high debt ones, the ones that everyone's going to avoid, which is what I like to look at, they get sold off the most in a correction. They get decimated. Some of them went bankrupt. Some of them didn't go bankrupt. And I played on that line of where some of them could go bankrupt. So I don't think they're going to go bankrupt now, but some went bankrupt, like Whiting Petroleum, WLL. I'm starting to look at that one. There's a couple of other ones. Noble. There's a VAL, I think, is another one that oil drilling company. They're all good. And if you can just get a little bit, spread it out. Remember the portfolio allocation strategy that we have, 1 to 5% in each position. That's where I like to be. Now, someone asked, you don't own any ETFs. I do own an ETF. I own REMX, and I also own some mutual funds in my 401k, but I really own a lot of individual stocks. ETFs are just watered down, not what you want, in my opinion, if you're looking into this stuff. My returns waste any ETF. Just absolutely decimated. Take an ETF, it's up 30 or 40%, multiply it by 4, and that's probably me on a yearly basis. So I've done very well this past year. I think my returns are like 250% over the past year for my entire portfolio. I do have some thousand percenters in there. I've got a couple 800 percenters. TTI's done very well. CDEV and SM Energy, a lot of the ones that I've shared on the company. I've got a whole bunch that are 300-400% up, like Crew Energy is somewhere up there. Birch Cliff's getting up there. All of them. They're anything with energy in it, they're all way up. And I'm starting to get into some of these energy service companies because they haven't gone up as much, and I think there's some pretty good opportunities there for value and for very large returns. I haven't seen this scenario in my life. When I first started investing, that was the beginning. It was in the middle of the last commodity bull market. It was like 2004, 2005, which was in the middle of that bull market, getting towards the end. But now I get to see it from the beginning of the bull market, and this has got me really excited. And everyone on this channel should be excited as heck for this bull market to come. The way that you play this is you find your companies, you invest, and you hold on for the entire bull market. That's playing the big trend. You will make so much money. It will be life-changing. It will be life-altering. And if you can do that, you're going to learn so much about investing when you subscribe to this channel and you're with us watching this and listening to me basically narrate what I see in the charts, look at the companies, the ratios, all those things. And what you're going to do is you're going to learn how to become a better investor. This took me a long time to figure this all out. Good 15 to 18 years is what I've been doing this. And I like this stuff. This is something that I really wanted to do over my life, is make a buttload of money. And it's taken me a while to piece it all together. The real estate portion, that last portion, was the hardest one to integrate into this thesis. Everyone else, it's like finance is here, real estate's here, and they kind of spread them, kept them apart. And I was like, man, I just started intermingling everything. And that's when it just stuck out. It was like, boom, the real estate market is the driver of it all. Because that's what I was missing. I was missing the driver and the rotation of money. That was the last thing I had to piece in there. Now it's just, I'm buying all these things and you guys are watching me do it. I'm doing it real time, right in front of your face. And some of you guys are participating in it. I can't give you guys advice, but if you guys want to ride along, that's perfectly fine. And you're starting to now see like huge money coming to you and being patient. You're going to see, we're probably going to have a pullback here for a little bit in maybe gold and silver. Probably uranium might pull back a little bit. But you know what? Use it as buying opportunities. Don't get scared. Don't get afraid. Now, if you guys are scared and you're afraid, go back, watch a lot of my videos. Watch what you need to look for. Look at the ratio analysis I've done. Go into the New Investor Series playlist. Watch all those videos. Put down questions if you have a lot of questions. Ask me whatever you need to. I'm here to support you guys. And I'm here to provide value, to find value. And again, I'm not the huge fundamental guy. I used to be more fundamental analysis. Right now, I'm relying much more heavily on technical analysis because it works better. It works 1,000 times better. And what usually happens is the natural progression of people. If you're an investor, when you're a new investor, the biggest shortcoming of a new investor is not being able to hold long enough. You should find your companies and then hold a really long time. Don't sell after months. Don't sell after years. You need to literally just let it sit in there. Don't do anything. Like, don't touch your account. Get your company, get a good stake, and just let it go. Let it go. Let it make you money. Now, I've gotten hit on some companies. I've gotten hit. There was one recently. I'm down probably 80% in it. Their license got rejected. I'm not going to do anything with it. If I lose that position, it's gone. That was probably about 0.5%. 0.5% would be flushed out. It's a junior copper company is the one that I'm in. I'm not going to do anything with it. And you know what? I positioned my portfolio to have that happen. And it was a small amount. I have a plan for it. Not worried. If it comes back and they get their license, then it comes back. But I'm going to write it off as a 100% loss. Most likely. And I mean, obviously no one likes seeing that, but it happens. And I'm used to it. I'm mentally prepared. So that's what I've got for technical versus fundamental. That's kind of the mindset that you need to have. And you got to stretch out your holding period. You got to stretch out what your expectations are for a 5 to 10 year hold. If you can do that, that was my biggest downfall when I was a new investor. I wasn't holding long enough. I mean, I should have held for 20 years in some of these companies, 30 years, I should still be holding them, 20 plus years. I should, you're 18 or 20 right now. I should continue to hold it for 30 years. I had Chipotle at $54. I should have held it the entire time. Beidou at split adjusted 10. It was 100 at the time, but it split adjusted down to 10. I should still be holding it. A lot of these companies I should still be holding. So that's my I guess experience is I need to hold, and I should have done less trading, less moving in and out, more hold, forget about it. Make more money, a lot more money. I'm not talking a little bit, I'm talking a lot more. 50 times more money, 100 times more money that I have today, which would then put me probably $60 to $100 million. If I had 50 times more, 100 times more, somewhere in that range. Okay, well, if you guys like this content, give me a thumbs up. Thank you for listening. This is Finding Value.